Let's look at the tape. We're sitting at exactly $398.02. The market is currently closed, as it is Saturday, November 22nd, 2025, but the last session closed with Tesla Inc., ticker symbol TSLA, up $2.98, marking a positive move of 0.75% for the day. This price point of roughly $398 is not just a number, it is a psychological battlefield. The expectation right now, if you read the standard headlines or listen to the general chatter on the street, is that Tesla is recovering from a period of stagnation, fighting to reclaim the $400 fortress that has historically acted as a ceiling for the bulls and a floor for the bears. The narrative suggests this is a simple story of an electric vehicle manufacturer grappling with interest rates and global competition. That is the expectation. But the reality is far more complex and, frankly, far more aggressive. The reality is that Tesla has effectively decoupled from the traditional automotive sector's logic and is trading almost exclusively as a derivative of global liquidity and artificial intelligence sentiment. We aren't just watching a car company try to sell more sedans, we are watching a capital allocation war between legacy value investing and the next generation of speculative growth mechanics. When you look at the intraday action from Friday's session, that 0.75% gain hides the violence of the actual trading day. We saw a significant amount of churn in the opening hours. If you were watching the order book, you would have seen massive sell walls erected right at the $399 mark, likely from institutional algorithms programmed to cap volatility before the weekend. Yet the stock held. It refused to flush down to the 380 support levels that many technical analysts were screaming about just last week. This tells us that there is a bid underneath this market that is not price sensitive. It is accumulation, plain and simple. This brings us to the core of what is happening with Tesla stock right now. It is behaving less like Apple stock, which has settled into a predictable dividend-paying maturity, and more like Nvidia stock did in its early hyper-growth phases, where every dip is aggressively bought by a retail cohort that simply refuses to capitulate. If you are managing your own capital, perhaps utilizing Schwab Intelligent Portfolios or a similar automated service, you might have noticed that the volatility weighting in your portfolio has shifted. Tesla is no longer just a high beta play. It has become a distinct asset class that correlates more with future tech adoption curves than with the number of cars rolling off a factory line in Texas or Shanghai. Let's talk about where this volume is coming from, because this is critical for understanding the smart money flow. We are seeing a massive divergence in platform behavior. On one side, you have the individual brokerage accounts, the people utilizing Robinhood stock trading or the Robinhood app, who are heavily leaning into weekly call options, betting on a breakout past $400. We can see this in the option chain volume. The implied volatility is skewing higher for calls expiring in December, suggesting that the retail crowd is positioning for a year-end rally. They are using Robinhood fractional shares to dollar-cost average into positions, indifferent to the price-to-earnings ratio, focused entirely on the momentum. Conversely, if you look at the flow coming through interactive brokers, which tends to skew towards more sophisticated, semi-professional traders and hedge funds, the story is different. The interactive brokers' trading data suggests a lot of selling into strength. These traders are writing covered calls, hedging their bets, and using the interactive brokers platform to execute complex spread strategies that profit from time decay rather than directional explosive moves. They are skeptical. They see the $400 level as a place to take chips off the table. This tension between the relentless optimism of the Robinhood crowd and the calculated skepticism of the interactive brokers crowd is what is pinning the price at $398. It is a perfect equilibrium of opposing forces. Now, consider the investor who is sitting in the middle. Maybe you use SoFi Invest or Fidelity Investments. You aren't day trading weekly options, but you aren't a hedge fund either. You are looking at SoFi investing articles or checking your Fidelity mobile app and wondering if you should add to your position here. The SoFi Active Investing dashboard might be showing you a hold rating, while your Fidelity Wealth Management advisor is telling you to be cautious about overexposure to consumer discretionary stocks. This is where the confusion sets in. Is Tesla a car company? Is it a tech company? Is it an energy company? The answer lies in the fundamental business shift that occurred throughout 2025. While the market obsesses over monthly delivery numbers from China, the internal reality of Tesla has shifted toward energy storage and autonomous compute. The megapack business is growing at a rate that eclipses the automotive segment in terms of margin expansion. We are seeing Fidelity mutual funds and Fidelity ETFs that focus on green energy infrastructure quietly increasing their weightings in Tesla, not because of the Cybertruck, but because of the utility-scale battery storage deployment. This is the Trojan horse thesis. You buy the stock for the cars, but you stay for the energy utility monopoly. Furthermore, we have to discuss the retail investor experience on platforms like Fidelity. If you look at Fidelity brokerage accounts, specifically Fidelity IRAs, we see a generational divide. Older accounts are holding Tesla stock as a legacy winner, rarely selling, treating it like a blue chip. Younger accounts are trading around the core position. This sticky capital in retirement accounts provides a floor for the stock price. It is very difficult to crash a stock when a significant percentage of the float is locked away in long-term Fidelity IRAs or passively managed in Schwab Intelligent portfolios. This structural ownership is often overlooked by bears who think the stock can fall 50% in a month. Unless there is a macroeconomic catastrophe, that supply is simply not for sale. Speaking of macroeconomics, we cannot analyze this price action in a vacuum. We have to look at the broader environment. Interest rates have stabilized, but they are not at zero. This matters because online investment and online investing habits change when cash yields 5%. Investors are smarter now. They know they can get a risk-free return. So for them to deploy capital into Tesla stock, the perceived reward must vastly outweigh the risk. The fact that Tesla is holding near $400 in a positive rate environment is a testament to the strength of its narrative. Unlike SoFi stock or other fintech plays that got crushed when rates rose, Tesla has maintained its premium valuation. Let's pivot to the competition, because expectations here are often misaligned with reality. The expectation is that legacy auto is catching up. We hear about Ford, GM, and Volkswagen launching new EVs, but the reality is that the gap is widening, not in terms of sheet metal, but in terms of software and data. When you look at investing sites that compare sector performance, you see legacy auto trading at single-digit multiples while Tesla trades like a software monopoly. This is because the market is slowly waking up to the fact that the future of transport is not about the drivetrain, it is about the operating system. The Robinhood crypto crowd often overlaps with Tesla investors, and there is a reason for that. It's the belief in decentralized automated futures. The same person who holds Bitcoin on Robinhood Cash Management is often the same person holding Tesla shares. They are betting on a disruption of the status quo. This demographic is resilient. They have weathered the volatility of 2022 and 2024, and they are still here in late 2025 bidding the stock up. Now, I want to take a moment to ask you something specific about your own positioning. I am curious about the sentiment among those of you watching right now. Comment below how many shares of Tesla you currently hold, and more importantly, at what price would you be willing to double your position? Are you waiting for a pullback to $350, or are you buying the breakout at $410? Let me know in the comments. Moving back to the analysis, we need to look at the tools available to you. Investment help is more accessible than ever. Whether you're using SoFi Robo-Advisor to automate your exposure or doing deep dives on the Interactive Brokers platform, the data transparency we have today is unprecedented. You can see the short interest. You can see the dark pool volume. And right now, that data is telling us that the short sellers are nervous. The short interest on Tesla has remained stubborn, but with the stock hovering at these highs, the cost to carry those short positions is painful. If we get a catalyst, perhaps a regulatory approval for full autonomy in a new jurisdiction, or a breakthrough in the Optimus humanoid robot timeline, we could see a squeeze that rivals the moves we saw in 2020. However, we must address the risks. The Interactive Broker's fees for borrowing the stock are fluctuating, indicating tightness in supply. If the macro environment turns, if inflation spikes again, or if we see a geopolitical shock, high beta names like Tesla and Nvidia are the first to be liquidated to cover margin calls. We saw this in previous corrections. Liquidity dries up and the bid disappears. If you are using margin on your Fidelity trading platform, you need to be acutely aware of this leverage risk. The drop from 400 to 300 can happen much faster than the climb up. Let's look deeper at the